Good morning, everyone. Thank you for joining us for today's Public Service Loan Forgiveness webinar, review and updates for 2023. This is the fourth of a 5 student loan webinar series. We have one more next month, so please subscribe to our DFPI newsletter to get information on date and topic, as well as other student loan webinars. Let me start with some housekeeping items. Throughout the entire webinar, your video, microphone, and chat feature will be disabled. You can enter questions in the Q&A function, but please hold off on your questions until we cover that topic, and we are covering a lot today. Also, please do not ask detailed personal questions since this is a public forum. If you have those questions, additional questions, you can send those to us directly. This event is being recorded and it will be available on DFPI's YouTube channel within the next few days or next week. My name is Selena Damian, and I am the Student Loan Servicing Ombudsperson at the DFPI, or Department of Financial Protection and Innovation. It is my pleasure to be here today with Betsy Mayotte, who is the president and founder of the Institute of Student Loan Advisors. She has been working in the student loan industry for over 20 years and has helped borrowers, thousands of borrowers, with their student loans. One of the most popular federal forgiveness programs is PSLF, and although it may seem confusing to understand, and right now the process is taking a little longer than usual, it is still one of the most valuable options for borrowers, especially if they are in public work. Here at the DFPI, and since the inception of our student loan program, we have seen borrowers receive over $1.2 million in PSLF. So to help you understand the program and how to successfully apply and obtain forgiveness, we will be providing really valuable information today. We will tell you a little bit about DFPI and some additional rights. Next, please. So as I mentioned, questions can be posted in the Q&A panel. Next, please. We will be talking about borrower rights, PSLF eligibility, loans, employers, payments, the new buyback program, how to apply, and then resources as well. Next, please. Just briefly about DFPI, we are California's Consumer Protection Agency. We were formerly known as Department of Business Oversight, so we have been around for quite a while. We regulate companies of financial products to ensure compliance, and that includes student loan servicers. And just so people understand the difference between the servicers and lenders, for federal loans, your lender is the Department of Education. The Department of Education contracts with companies, these student loan servicers, to manage your federal student loans. These servicers will be your main point of contact. They are the ones that you contact about repayment options, about your bills. They're the ones who take your payments. So when you are paying your student loans or applying for any of these forgiveness programs, you are doing that through your servicer. DFPI also accepts and evaluates consumer complaints against student loan servicers or any other financial company. We take enforcement and legal action when companies are not in compliance, and then conduct education and outreach, such as this one, to protect consumers from fraud and abuse. Next, please. And TISLA, that's Betsy's organization, is a nonprofit organization that offers free, expert, unbiased student loan advice and dispute resolution. Next, please. And then just something really important for borrowers to be aware of is the California Student Borrower Bill of Rights, or Assembly Bill 376. This law applies to student loan servicers doing business in California. This applies to borrowers with both federal and private loans. It prohibits servicers from engaging in abusive, unfair, or deceptive practices, and it requires that they work in the best financial interest of borrowers. It requires that servicers provide accurate information about repayment options, income-based repayment plans, and federal forgiveness plans. So if you're calling your servicer to find out about PSLF, they should be giving you accurate information. And this is really important, protects borrowers from any negative consequences stemming from a sale, assignment, transfer. During the COVID payment pause, millions of student borrowers had their accounts transferred to new servicers. So if a borrower suffers or experiences any negative consequences, credit reporting, incorrect account history, or anything, they can go ahead and file a complaint. It also requires that servicers respond to a borrower's qualified written request within 30 business days, so they should be answering any of your requests in a timely manner. It establishes special protections for military borrowers, those working in public service, older borrowers, and those with disabilities, and any borrower that has an issue with their servicer, especially right now with the restart of repayment. They can go ahead and file a complaint with our agency, and I am encouraging borrowers to apply, whether it's if they're not answering their phone, if they're getting inconsistent payment amounts, incorrect PSLF counts. It's important to have all this in writing, all that information that they're giving you. Next, please. All right, PSLF. So Public Service Loan Forgiveness was a program that was created in 2007 to encourage individuals to enter and remain in public service. Under this program, student loan forgiveness is granted after satisfying certain criteria for 10 years or 120 payments, as Betsy will explain in a few minutes. There was a PSLF waiver that was created in 2021. It expired October of last year. However, some of those benefits were extended, but the waiver did expire last year. And as of October of 2023, 715,000 borrowers have received $51 billion in PSLF forgiveness. Next, please. The criteria, the requirements to obtain forgiveness under this program is you have to have 120 eligible payments on eligible loans while working for an eligible employer. So all of these things must be happening at the same time. And with that, I will hand it over to Betsy to get into detail on these requirements.
Thank you, Selena. Before I get started, I just want to reemphasize sort of the ground rules for Q&A today. We have over 2,000 people that registered for this webinar, which we're delighted about. But that means we've got to sort of have some organized chaos here. So we are going to ask that you hold off on your questions until we cover the topic that your question is about. If Selena and I are doing our jobs right, we're going to tell you, we're going to answer your question as part of our narrative. The other thing I want to reemphasize is to check the Q&As that have already been answered to see if your question has already been answered. For example, when I just checked about 30 seconds ago, we had 9 different people ask if the recording was going to be published. And that question has been answered. So it is over in the Q&A. And then the third reminder is that this is public forum and it is being recorded. So you don't want people knowing your business. So you're going to want to leave out any, if your question is really detailed and has a lot of personal information, the Q&A on this live webinar probably isn't the place to put it because everybody's going to see the answer. I do see people raising their hands. I'm going to wave right back. You can't see me, but I'm waving right back at you. Because we have over 2,000 people registered for this, we are not going to be unmuting. So raising your hand, unfortunately, isn't going to do anything except cause me to just wave right back at you. Again, you want to put any questions that you have in the Q&A, but we would ask that you hold off on those questions until we cover that particular topic in case, and hopefully we will be answering that question along the way. So with all those reminders to get us under organized chaos, I'm delighted to jump into this. I love talking about student loans. I could talk about it all day, every day, and PSLF is one of my favorite topics. I want to go back to Selena's last slide, because to me, it's one of the most impactful slides in this whole presentation. Because if you remember the premise of what you see in front of you right now, you're going to be able to answer 95% of any question you're going to have about PSLF. So, PSLF gets a bad rap of being an overly complicated program. But I think if you take a step back and again, look at this particular slide, almost all of it becomes clear. And so just to reiterate what Selena said, in order to get the balance of your federal student loans forgiven, you have to make 120 eligible payments on an eligible loan while working for an eligible employer. And yes, and in another minute or so, I'm going to define all of those eligibles. But the key here, what I'm trying to project, is that in order for a month to count towards the 120 months you need for PSLF, all three of these things have to be happening at exactly the same time. So, for example, you could be making an eligible payment on an eligible loan, but if you're not working at eligible employment during that same month, that month will never count for PSLF. On the same premise, you could be working eligible employment and making an eligible payment, but if you didn't make that payment on an eligible loan, that month is not going to count for PSLF. And you could mix and match these three things however you like, and the answer is always the same. That in order for a month to count for PSLF, all three of these things have to happen at exactly the same time. So that also brings me to another really common question that we get, which is, we get different variations of a question that essentially boil down to, is there any way of getting PSLF in less than 10 years? And the answer is a hard no. There is absolutely no way to get PSLF, by making extra payments or working extra hours or doing some other type of voodoo magic to get PSLF in less than 120 months, and 120 months is 10 years. So at a bare minimum, you do need to be working eligible employment for at least 10 years in order to get your balance forgiven under PSLF. Another common question we get about forgiveness for PSLF is it taxed? Is the forgiveness taxed? And PSLF at the federal level, the forgiveness amount is not taxed. There are some states, I think we're down to 2, that actually do tax the forgiveness at the state level, but and Selena can correct me if I'm wrong, but I do not believe California is one of those states. So PSLF is not taxed. So with all that sort of commonality out of the way, I'm going to dig in and start defining for you all of those eligibles that I mentioned. The first eligible that I want to define is probably the easiest one, which is, what is an eligible loan when it comes to PSLF? And just like most things with student loans, there is a short answer and a long answer. So the short answer is that all federal direct loans are eligible loans for PSLF purposes. Now, when I say federal direct, or DL, that's a program. It's not an actual loan. The direct loan program is a program. Within the direct loan program, you have subsidized and unsubsidized Stafford loans, you have graduate plus loans, you have parent plus loans, you have consolidation loans, and it doesn't matter when that direct loan was made. They made the very first federal direct loan back in 1994. If you are holding a vintage 1994 direct loan, that is just as potentially eligible for PSLF as a bright and shiny 2023 direct loan. So again, any direct loan, so any loan under the federal direct program, is potentially eligible for public service loan forgiveness. Now, here's where it gets a little squirrely. Back before 2010, there were actually 2 primary federal student loan programs. There was this federal direct program that I've already mentioned, and then there was a program called the Federal Family Education Loan Program, or FEL. And both of those programs were exactly the same, except where they were different. They both had subsidized and unsubsidized Stafford. They both had Graduate Plus. They both had Parent Plus, and they both did consolidations. As you'll see in a second, FEL loans are not eligible for PSLF, but they can be made eligible. So if you have loans prior to 2010, you need to know whether it is a FEL loan or a direct loan. If it was made after 2010 and is a Stafford or a Plus or a consolidation, it's absolutely a federal direct loan. But if it was made prior to July 1st, 2010, you need to figure out whether it's a FEL or a DL loan. And there's 2 ways to do that. One, log into your servicer website, and most of the servicers, with the exception of, I think, Nelnet, very clearly will say FEL Stafford loan, or FEL Plus loan, or direct Stafford loan, or direct Plus. If you're still not sure, call your servicer and ask them. They'll know immediately whether the loan is a FEL or a direct. But again, if the loan was made after 2010, even if it was a consolidation, and it's a Stafford or a Plus or a consolidation, then you know that it is a direct loan and not a FFEL. Now, if you do have a FFEL loan or a Perkins loan or a federal nursing loan, one of the old HEAL loans, or any of the federal loan programs that you see in front of you right now, those are not eligible for PSLF in and of themselves, but they can be made eligible for PSLF if you consolidate them under the direct loan program, which you would do at studentaid.gov. Process is super easy. The application process, if you walk into the application process with a list of your loans already in front of you, I would say the process takes less than 15 minutes. If you have to go searching for your loans, it's going to take a little bit longer, but the application's really, really easy. Now, things have changed as far as the rules of consolidation go. It used to be that any payments that you made on a FFEL loan would never count. Go back to, remember that first slide. You have to make 120 eligible payments on an eligible loan while working for an eligible employer. So it used to be if you consolidated the FFEL loans or any of the others, that any of the payments made prior to that consolidation would be zeroed out. So you'd be starting from scratch. Thanks to a temporary waiver, if you do have FFEL loans or Perkins, or for some reason you want to consolidate your direct loans together, and I'll talk about why you might want to do that later on in the presentation. If you apply for that consolidation before December 31st of this year, you will get credit for any eligible payments you made on a FFEL loan or on the direct loans. You never get credit for payments made on a Perkins or the HEAL loans or any of the others, but for FFEL or direct loans that are consolidated prior to the end of this year, you will actually get credit for any prior payments. So that's a temporary deadline. Now, if you consolidate after December 31st of this year, and by the way, to be clear about what the real effective date of that deadline, that December 31st deadline is, it's completed consolidation application submitted on or before December 31st. That will make that waiver deadline. So the consolidation doesn't have to be complete and funded by then, it just has to be applied for. If you apply for a consolidation after December 31st, 2023, you will not get credit for any payments you made on a FFEL loan. And consolidations for direct loans will get, if any of those loans had prior PSLF credits, they'll get a weighted average rather than the maximum count that they can get. And we're going to talk more about that consolidation stuff later on. So again, just to backtrack, a PSLF eligible loan is any direct loan. FFEL loans and these other federal loan programs you see in front of you can be made eligible by consolidating. So just to be extra clear, if you consolidate a FFEL loan after December 2023, it will still be then eligible for PSLF, but again, you won't get credit for any of the payments made on the FFEL loan prior to that. Okay, so we've defined what an eligible loan is. It's any direct loan. Now let's talk about what an eligible employer is. Now there's a lot of myths that scurry around regarding PSLF, and I think the majority of those myths exist under what is considered an eligible employer. So let's get rid of those myths right off the bat. It does not matter what you do for a living at all. Doesn't matter what your title is, doesn't matter what your day-to-day functions are at all. What matters is who you work for. You need to work for what's considered an eligible employer. Let me give you an example of what I mean. I'm from Massachusetts, and so I like to use the example of the Boston public school system. If you were to poll the employees of the Boston public school system that had federal student loans, I can pretty much guarantee you that all of the teachers would be at least somewhat aware that they were potentially eligible for PSLF because they worked for the Boston public school system. I can also pretty much guarantee you that everybody else that worked there might not realize that they are just as potentially eligible for PSLF as the teachers are. That I'm including the cafeteria workers, the custodians, the groundskeepers, the principal, the administrative assistants, the gym teacher, because again, it does not matter what you do for a living, it matters who you work for. And the Boston Public School System is an eligible employer for PSLF purposes. Now, it must be paid employment, so volunteering does not count. You need to be considered a direct employee of that employer. You have to be working at least 30 hours a week for eligible employers. Now, it doesn't have to be 30 hours a week for a single employer. If you have multiple part-time jobs and all of those employers are PSLF eligible and it adds up to at least 30 hours a week, then that is considered eligible employment. Now, that's a recent change. It used to be you had to be working full-time. You had to be defined as full-time by your employer, and that's no longer the case. You just have to be working at least 30 hours a week. Now, I'm going to define an eligible employer starting in the very next slide, but the best way to verify that your employer is eligible is to submit the Public Service Loan Forgiveness Form. We also call it the ECF, or Employment Certification Form. You can do that at studentaid.gov by using the PSLF help tool, and we'll go into more detail of that later. Now, technically, you are not required to submit that form until you think you've hit the 120. I am here to tell you that is a terrible, terrible strategy. Anybody that you've ever talked to that said, oh, I worked for however many years and they denied me PSLF. That's someone who did not submit their form on a regular basis. The best way to keep track and make sure that you're on track for PSLF is to get in the habit of submitting proof of your eligible employment on an annual basis. That way you'll be able to verify once they send you back your approval and your count. That's how you'll verify that you've been making eligible payments on eligible loans while working for an eligible employer. All right, so let's talk about what an eligible employer is. There's really three categories. Two of them are super easy, one and done. The first easy one is any government employer. That's federal, state, local, or tribal. That includes work being full-time in the military, the Peace Corps, or AmeriCorps. If you're working for a government employer, you are working for a PSLF eligible employer, full stop. There's no other checkboxes or hoops to jump through. Now, one thing I just want to remind you is you have to be a direct employee of that employer for it to count. Contractors are not government employers. So, you could be walking into a government building, sitting at a government desk and answering a government phone every day for 40, 80, 100 hours a week. But unless your contractor that you're an actual employee of is in and of themselves a PSLF eligible employer, which most of them are not. Most contractors are for-profit organizations and therefore not PSLF eligible employers. So 99.999% of the time, being a contractor is not going to count for PSLF. Now, the second easy category is if you work for a 501c3 nonprofit. If you work for a 501c3 nonprofit, you are working for an eligible employer. Again, full stop, no checkboxes, no hoops to jump through. The one that gets a little more complicated is if you're working for a nonprofit who's not a 501c3. Maybe they're a 501c4 or one of the other 50 designations that the IRS gives to certain nonprofits. If you're working for a nonprofit that's not a 501c3, in order for that employer to count, their primary reason for being has to be one of the bullet points you see in front of you. Say early childhood education, public library services, law enforcement, public service for people with disabilities or the elderly. Now, when I say this has to be their primary reason for being, let me give you an example. Let's say you worked for a nonprofit whose mission was to help stray dogs and cats. And that was their mission. That was the reason that they exist. And they're not a 501c3. But they are a nonprofit. They're just not a 501c3. And it so happens that part of what they do is they offer public education courses for free to the public about how to care for your animals, like, when you should get their vaccinations and what health problems to look out for. That would not be a qualifying employer for PSLF purposes, because they might do some public education, but it's just sort of a side hustle, so to speak. It's not their primary reason for being. Their primary reason for being is animal welfare. And animal welfare is not, although I think it should be, is not one of the bullet points that you see in front of you. This is a finite list that you see in front of you. So if it's not on this list and it's not a 501c3 nonprofit, it's also not going to qualify for PSLF purposes. Now, non-eligible employers include labor unions, partisan political organizations, and just to be clear, even if they're nonprofits and even if they happen to be 501c3s, although I don't think they can get a labor union or a political organization can get a 501c3 designation, but even if they could, they still can never be PSLF eligible employers. For-profits also can almost never, there's a new rule I'm going to talk about in a second, can't be eligible employers. And as I mentioned before, a nonprofit that's not a 501c3, whose primary reason for being is not one of the bullet points on the prior slide, is not going to be a PSLF eligible employer. So let's talk about this weird little exception that actually happens to apply to California. And this is a very recent rule change. So apparently there are, as far as we know right now, 2 states, Texas and California being them, that have a weird state law that someday when I have time on my hands, I'm going to look up and figure out why this law exists, where the state law specifically prohibits nonprofit hospitals from directly hiring doctors. So what those hospitals do is they create a for-profit arm of the organization, and the for-profit arm hires the physicians even though they're doing all their actual work for the nonprofit entity. So in that scenario, and right now that's only in Texas and California and only in the case of these doctors, they do make an exception for eligible employment. Now, if they discover other states and other laws that do the same thing, they will add those in there. But as far as we know, and as far as the Department of Education knows, these 2 laws are only exist in Texas and California, and it's only specifically for hospitals and physicians. So I just want to make sure it's clear, however, that that doesn't mean that all doctors working for for-profits can now get PSLF. That this exception only applies if you're working for a for-profit, but actually all of your work is being done for the eligible nonprofit. Now, because this rule is fresh and shiny and new, and the government form process is old and creaky and slow, the current PSLF form does not include this new rule. So what I've been experiencing with borrowers who do fall under this really narrow umbrella is that their employer has been refusing to fill out the form. Now, who's supposed to fill the form out in this case is actually the nonprofit arm that the physician is working for. And I kind of don't blame them, because if they read the form, it'll appear like they're committing some sort of fraud by certifying your employment. You have a couple choices. You can either send them to this recording of this webinar to let them know the rule has changed, or just wait out the new form that will include the new language that will make them feel better about signing off on the form. When is the new form going to be available? I wish I could tell you. The Department of Education has lots and lots and lots on its plate right now. And as I mentioned, the form process can actually take up to a year. So I would not expect a new form in the next couple of weeks, unfortunately. All right, so we've defined 2 of our 3 eligibles. We know what an eligible loan is. It's any federal direct loan. We know what an eligible employer is. It's any government employer, federal, state, local, or tribal, any 501c3 nonprofit, or in some narrow cases, some other nonprofits whose primary reason for being is one of the bullet points that we listed on the prior slide that you can also find on the Department of Ed's website as well as the TISLA website. Let's define our last eligible, which is eligible payment. An eligible payment is one that's made on or after October 1st, 2007. Now, I'm going to talk about some waivers in a second. This waiver does not waive this part of it. PSLF was not written into law until October of 07, so there are no scenarios, zero, where any payment made prior to 10/1/07 can ever count for PSLF. An eligible payment under normal PSLF rules has to be made under a qualifying repayment plan, and I'm going to define that in a second. It has to be for the full amount due as shown on your bill. Now, they used to not allow you to prepay or make lump sum payments to count for PSLF. They actually do now in a limited way. Now, to be clear, this still isn't going to get you PSLF in less than 10 years. But let me give you an example where a lump sum payment would count. Let's say your payment plan amount is $100 a month. And in January, you make a $1,200 payment. Unless you tell them differently, they're going to count, that's essentially 12 months worth of payments. So you're not going to be due for another payment until January of the following year. Once you certify your employment for that year, which by the way, you can't do until you've worked it. You cannot certify future employment. So again, going back to my example, January of 2023, you make a $1,200 payment. That means you're not due for a payment again until January of 2024. In January of 2024, you certify that you did work eligible employment all of 2023. Then they'll count those 12 payments. The only exception to that is for the income-driven repayment plans, which as you'll see, you really kind of need to be on an income-driven plan to benefit from PSLF. They'll count lump sum payments up to either 12, so no more than 12, or until your next income-driven plan recertification date is required, whichever is soonest. So going back to my example, your payment's $100 a month. In January of 2023, you make a $1,200 payment. But now in this scenario, you're due to recertify your income-driven plan in June. In that case, that lump sum payment will only take you through June. I mean, in most, just to make sure that everyone understands the benefits of lump sum payments, there is none. The reason this rule is, it's good that they changed it, is because there are some people that are lucky enough where someone's making payments for them. Maybe it's their employer. Maybe they're getting payments made by the Department of Defense because of prior military service. In the scenarios where employers or say the DOD or another entity is making payments, they tend not to make monthly payments. They make big chunk payments once or twice or maybe quarterly a year. That's who this lump sum rule benefits. Because before they changed the rule, people that were getting this benefit were still having to make their monthly payments after that. So for anybody else, there are zero benefits. In fact, you're sort of robbing yourself of interest you could be earning in your own bank account to be making a lump sum payment like that if you're pursuing PSLF. Payments made while you're in default never count, even under the waivers I'm going to talk about. And again, go back to my first slide. They are only going to count if you were working 30 hours a week for eligible employment during the month that you made that payment. And it doesn't matter who makes the payment, whether it's an employer, whether it's the Department of Defense, whether it's you. Another common scenario that we see are people with Parent Plus loans. There's a lot of families that have an arrangement where mom or dad takes out the Parent Plus loan because that's who has to take it out. And then the child who benefited from that Parent Plus loan has agreed to make the payments. That's fine. They'll take those payments. Those payments will count for PSLF. But what you need to know is that to get PSLF for a Parent Plus loan, that is based on the parent borrower's employment. even if it's the child making the payments. And the payment amount is going to be based on the parent borrower's income, even if it's the student who is the one making the payment. So again, they don't care who makes the payment, they'll take it, they'll count it, but all the qualifications are going to be based on the actual borrower of the loan. And to preempt the question we always get after this, there are 0 ways to change who the borrower is on the loan and keep it eligible for PSLF. You can refinance a Parent Plus loan into the private loan program, but that's a terrible idea for a whole bunch of reasons. The main one for the purposes of this presentation is that private loans are never eligible for PSLF. Addison, I'm going to take a breath and ask you, are there any questions that have come up so far that you think would be good for the whole group to hear?
Well, there have been lots of questions about posting the recording. So if DFPI could send me a link that we can post for people, that'd be very helpful.
Great. Any program questions that you think we should cover now for everybody?
Lots of questions about IDR plans, and there seems to be confusion about thinking that you can't be on an IDR, that an IDR plan preempts PLSF or the opposite.
Okay, we're going to talk about IDR plans next, so hopefully I'll be able to cover most of those questions. But I think, it sounds like we need to make a clarification that public service loan forgiveness and the income-driven plans are separate things. They do dovetail together in that, as you'll see, you really need to be on an income-driven plan to benefit from PSLF. But they are separate things. So changing payment plans is not going to reset your account. There really isn't anything. If people are worried about getting their PSLF count reset to 0, there really isn't anything that will reset it to 0 today. It used to be consolidation reset it to 0, but that's no longer the case. So there's really no risk of resetting your PSLF count to 0 anymore. You can't screw that up. Ooh, sorry about that. Okay, so let's talk about eligible payment plans. So remember, in order for a month to count, you have to make an eligible payment on an eligible loan while working for an eligible employer. Now, what you see in front of you are the eligible repayment plans. They are the 10-year standard repayment plan. So let's talk about that for a minute. Unless you actively choose a different plan, the 10-year standard is what you're going to be put in when you first go into repayment. The way the 10-year standard plan works is you're going to make the same payment every month for 120 payments or 10 years, and at that point the loan will be paid in full. So while payments made under the 10-year standard count, if you're on the 10-year standard for 120 payments, you're not going to get forgiveness. You're going to pay the loan off. So that's why you really need to be on one of the income-driven plans to benefit from PSLF. Now, there's actually 5 IDR plans. There's income-based, there's actually 2 income-based repayment plans. Believe it or not, because we're not super creative here in the student loan industry, there's new IBR and there's old IBR. And those programs have very different terms. Old IBR is the only income-driven plan that FFEL loans are potentially eligible for. So if you're on old IBR, which they utilize 15% of your discretionary income to determine the payment, you're going to want to double check and make sure that you have direct loans rather than FFEL. That's a common pitfall that we saw people fall into. They thought they were on an eligible plan. They were. They had eligible employment, but they didn't realize that the FFEL loans didn't qualify without consolidation. So that's something to check for. So we've got old IBR and new IBR. We also have pay as you earn or payee. And then what used to be called repay or revised pay as you earn, but is now called the save plan. And finally, we have income contingent repayment or ICR. Now let's talk about ICR for a second. Parent Plus loans, as I mentioned, are absolutely eligible for PSLF, But boy, do they not make it hard for those poor Parent Plus borrowers to qualify. Parent Plus borrowers are not in and of themselves eligible for any of the income-driven plans. They're eligible for the 10-year standard, but remember, you make 120 payments on a 10-year standard plan, you've paid the loan in full. Now, under the law, you can consolidate a Parent Plus loan, at which point it becomes eligible for ICR and ICR only as far as the income-driven plans go. That's fine, except that ICR for many borrowers tends to be the most expensive monthly payment under the different income-driven plans. Now, there is a loophole. That loophole is closing July of 2025. And unfortunately, we don't have time to go into the details of the loophole, but it's called double consolidation. Essentially, if you consolidate a Parent Plus loan twice, then you can, and you do it before July 2025, then that loan is potentially eligible for SAVE, the IBR plans, and depending on the age of the loans, maybe even pay as you earn. Now, we have all the rules and step-by-step instructions written out about double consolidation on the TISLA website. Addison, if you could take a second from your very fast Q&A answering and put the website in the chat, that would probably be a good thing. But essentially, the way double consolidation works is you have to consolidate each Parent Plus loan twice. So to give you a quick example, and again, if this makes your head spin, don't worry about it. It's a loophole. That's why it's a little confusing, but we have it all written out in very easy step-by-step instructions on our website. But just really quick, if you had 4 Parent Plus loans, and let's call them loans 1, 2, 3, and 4, the way you would do double consolidation is first you'd consolidate loans 1 and 2 together to create one consolidation loan. Then you'd consolidate loans 3 and 4 together. Now you have 2 consolidation loans. And then the last step is to consolidate those 2 consolidation loans together. That's a double consolidated Parent Plus loan. Again, this loophole closes July of 2025, meaning you have to have the double consolidation completed by then, like completed and funded, as in step 3, that last consolidation loan exists. Not all Parent Plus borrowers need to go through that nonsense. You might find that the ICR plan is affordable and will get you PSLF, so you don't need to go through the double consolidation nonsense. But for a lot of Parent Plus borrowers, that loophole can really save them a lot of money. Now, you don't have to be on the same income-driven repayment plan for all 120 payments. As I mentioned, changing plans is not going to reset your count in any way. You don't have to make consecutive eligible payments. You don't have to have consecutive eligible employment. And again, all these plans that you see in front of you will count for PSLF, but they're only going to count if they're made on a federal direct loan. So a couple things I want you to remember. You do have to be employed at an eligible employer for every single one of the months of the 120 months. So at the time you make every one of those 120 PSLF eligible payments, you also have to be working for an eligible employer at the time you actually apply for loan forgiveness. Now, it used to be you also had to be employed at an eligible employer at the time that they processed your forgiveness. That last rule has gone away. So while you do still have to be working for an eligible employer at the time you submit your application that says, hey, I think I did it, you don't have to wait around for them to approve your forgiveness if you're going to leave your job or retire or whatever it is. Again, you don't have to work for the same employer for all 120 payments. They don't have to be consecutive. You could go into the private sector for a while, or maybe be a stay-at-home parent for a while, or become less than 30 hours a week for a while. That's fine. Your prior payments are not going to go away. We talked about the taxability. Now, most people had their loans on hold during the COVID period that ran from March of 2020 until the end of August of this year. Those months count for PSLF, full stop. As long as you were working for eligible employment at the time, you did not need to be making payments during those months for those months to count. You just need to submit proof of that eligible employment. To take it a step further, the Department of Education is also counting September. So even though September wasn't under the COVID pause, everybody's loans were in what we call administrative forbearance, and the Department of Ed has stated in writing that they are counting September. And I'm emphasizing that because unfortunately, I've heard from some borrowers that some of the call center reps are saying that September doesn't count. I'm here to tell you that it's in writing from the Department of Ed that September does count. The other thing that counts, listen, I know that everything is chaos right now. We are in an extraordinary time for student loans where 40 million people are all re-entering repayment at exactly the same time. As expected, I wish I could tell you this wasn't expected. People are experiencing hours and hours and hours of hold times trying to get in touch with their servicers, delay in processing payment options, delay in processing PSLF forms. That's going to settle out as as people get back into the swing of things of repayment. But for now, it's chaos. I'll be the first one to say it. Some people are getting put into what we call administrative forbearance because their servicer has so much volume that they're taking longer than they're supposed to process your lower payment option. The Department of Ed has also said that those periods of administrative forbearance due to delay in processing of a payment plan will count for PSLF as well. There was one last thing. Oh, buyback. So here's another new rule. This is something that a lot of borrowers were anxiously awaiting, and some of them may have been a little disappointed when they saw sort of the narrow scope of it. Another new regulation is being called buyback. And this new regulation allows for months that normally would be considered not eligible months for PSLF to be quote unquote purchased back for PSLF purposes. So for example, periods that you were in school or in your grace period or in what we call a voluntary forbearance where you call and say, I can't pay my loans, put them on hold. Those normally don't count for PSLF, but now you're going to be able to have the option to buy them back, to get them to count for PSLF, but only in certain circumstances. In order to utilize buyback, you already have to have 120 months of qualifying employment credited to your account. So if you're only 5 years in, you cannot use buyback. You still have to have a balance on your loan. So in other words, you can't use buyback on a loan that's already been paid in full or forgiven. And you can't open that loan back up to do it. And the way buyback works is that you'll have to submit proof of your income and family size for the months that you're trying to buy back. And then the servicer is going to calculate what you would have made, how much your monthly payment would have been during those months. And you have to make that monthly payment. And once you do that, they will give you credit for those particular months. Now, the instructions on how to go through buyback are a little more, there's a couple more steps that I haven't mentioned, but you can find all of those on the link that you see below. Or if you just go to the studentaid.gov site and do a search for buyback, it'll come right up. But to be crystal clear, you cannot use buyback until you've submitted proof of 120 months of qualifying employment. The other thing I want to mention about buyback is you cannot buy back any months, no matter what, if it was before a consolidation. So let's say you had months in an in-school deferment in 2012, and you want to try to buy those back. But you've since consolidated, you will not be able to buy those back. Now, there's other fairly recent changes. They actually instituted this as part of last year's waiver, where if you feel like your payment count is incorrect, you can request what's called reconsideration. And the reconsideration process is also in that same link. You can find information about reconsideration, or you can find it on our website. Reconsideration is not for situations where you think your employer should be eligible and they say it's not. It's not for situations where you don't agree with the rules for PSLF. It's for situations where, they say that you weren't under an eligible plan, but you have proof that you were under an eligible plan. That would be a situation where you might want to file for reconsideration. Now, with all of that said, I don't recommend that anybody file for reconsideration or buyback now. And the reason is because of a waiver called the one-time account adjustment that's in the process of being implemented. The one-time account adjustment, which we have a link to at the end of this presentation, that's going to be automatically processed on all direct loans. There's no application for it. It's just going to happen. For some people, it already has. And under that one-time account adjustment, they're going to give people credit for past payments that would normally not be eligible. So they're going to give you credit, assuming you were working eligible employment at the time, for months on any repayment plan. Doesn't have to be an income-driven plan. They're going to give you credit in some cases for some deferments. They're going to give you credit for some situations of forbearance. So once they do that adjustment, you might not have to do buyback or reconsideration. So again, I'm recommending that nobody file for either one of these yet. Wait for the one-time adjustment to be done on your account. When will that be? Sometime between now and the end of next year. They have to do this adjustment on tens of millions of accounts. They're doing it in batches, approximately every 2 months, and they anticipate being done by the end of next year. So we're going to have to put our patience pants on a little bit to wait for that adjustment. But after that one-time adjustment is done, and you'll get notification when it is, if you are eligible for buyback and want to do it, or you still feel like there's something wrong, go for it and go through the buyback or reconsideration process. All right, so before I pass it over to my dear friend Selena, I just want to check with Addison one more time to think, are there any questions about PSLF eligibility that I haven't covered, or you think I should cover?
Yeah, there still seems to be some confusion about which plans qualify and whether the new SAVE plan is eligible.
Okay. So what you see in front of you are the only plans that are eligible for PSLF going forward. So not including the waiver, but the waiver is only going to look in the past. So going forward, you have to be on one of the plans in front of you. Either the 10-year standard, which again is not a good strategy for the long term, either new IBR or old IBR, pay as you earn, revised pay as you earn, or save. So save 1,000% counts for PSLF, or ICR. If you have a consolidation loan and you're not on an income driven plan, you are not on an eligible plan. If you're on the graduated repayment plan or extended repayment plan, you are not on an eligible plan, and you need to get on an income driven plan. So just to recap, to qualify for public service loan forgiveness, meaning having the remaining of your balance, including any outstanding interest, forgiven, you have to make 120 eligible payments, which is any payment made under any of the income-driven plans or the 10-year standard plan, on an eligible loan, which is a federal direct loan, while working at least 30 hours a week for either a government employer, a 501c3 nonprofit, or for, in some narrow exceptions, some another nonprofit who fits the criteria that I went over before. So with all of that, I'm going to pass it over to Selena, who is going to tell you how to apply.
Hi. Thank you, Betsy. Okay, so we've had a lot of questions. Just really quick, I do want to say forgiveness, once you get to the 120, your principal and interest, so the entire balance remaining is forgiven. Okay, so there were some questions on that. How to apply for PSLF. Next, please. We only have 5 minutes, so I will have to breeze through this. First of all, is your employer a qualified service employer? So FSA has an employer eligibility search tool. Here is the link. You will need your employer's federal employee ID number, which is found on your W-2 form. For the state of California employees, we all have the same FEIN, even though we work for different agencies. So we're all under that same, you're going to use state of California. It doesn't matter if on your PSLF form, whether digitally or on the paper form, if you put your agency, as long as you have that correct number. You need to find out what loans do you have. If you have the correct loans, Betsy just explained, you need to have those direct loans, and then consolidate if necessary. You submit your you can now submit your form electronically through DocuSign. Okay, you will need the correct address for an authorizing official. So for state of California employees, that is going to be your personnel analyst, the person that processes your 634s. So you can submit that through them. So make sure when you go in to submit to complete this form, that you know who your personnel analyst is, because you will need their email. Next, please. Oh, it looks like we didn't update this. Okay, there is an email that they are going to get from DocuSign. When you submit this through this new process, the personnel analyst has the option to change the form, make edits, or deny the form. So you will receive notification when there are any changes to that form. For those of you that don't have access to DocuSign or just still feel more comfortable with the paper form, this is what the form looks like, the original paper form. But through DocuSign now, everything is done electronically. You no longer need to fax or scan the form. And as you can see, it's the employee section or borrower section, and then employer section, and the certification, which is super important. Next, please. And then just really quick, beware of student loan scams. So with all this confusion that's going on with student loans and all the changes, we are seeing a lot of debt relief companies and other scammers contacting borrowers to help them get forgiveness, help them with consolidations that they may not need. They're offering to lower payments, and they're offering all kinds of services. So it's very important that if you receive a letter, a text, a call, make sure you are verifying who it is. I can tell you one thing, those servicers, your student loan servicer and federal student aid, they are not calling to bother you. They are not calling you to offer anything. They are not making any outbound calls. The only way that they're communicating with you is through your portals or through mail. So make sure very important, know who your servicer is. No one else can help you with any of these programs. I know they're confusing. I know there's a lot of, it's a process, right? That you do have to do some of your research, contact us, but you do not have to pay, shouldn't be paying anyone for any help with these programs. Never give out your login information, and then do not subscribe to any monthly service. So I've seen borrowers that thought they were paying their servicers, thought they were making payments, and it ends up they were paying someone else. It wasn't going to their servicers. So very important, know that you're only going to be dealing with 2 portals, studentaid.gov, which is the Department of Education's main site, and then your servicer. You may have multiple servicers if you have multiple loans. So it is very important that you identify who they are. If you get a letter and you see a name on there, the name may sound like it's affiliated with the government. Google the number and then look at the fine print. Many times they will say that they are not affiliated with Department of Education. Next page. These are the links for federal student aid, and then these are our contact. This is our contact information. You can go ahead and email us directly for questions, but these links are going to have a lot of the questions that have been asked today. This is where we understand all the information that we get comes from Department of Education, and we are just helping interpret, help guide you. But all these processes, PSLF, will be done through Mojila, through the servicer, and then approved by Department of Education. So these are your go-to links, and then we are right at 12 o'clock. So thank you, everyone. This recording will be up within the next week on our DFPI YouTube page. Thank you, Betsy. Thank you, Addison and Antonia, and thank you, everyone, for joining.
Thank you, Selena. Listen, I just want to add a couple last things before I stop the recording. I love the messaging from Selena about the scams. Unfortunately, we see them all the time. I do want to clarify that if you fall past due on your loan, your servicer will call you. But that's the only time your servicer will reach out to you directly unless you have some sort of direct dispute. The other thing I want to mention, I was looking at the questions, and I know we have a lot of outstanding questions. What I think I'm going to do is, as soon as I make this last statement, I'm going to stop the recording, but I'm going to hang out for a while longer and try to answer some Q&A, some of the extra Q&As in there. You know, we talk a lot about forgiveness, and this program is great, and if people are eligible, they should 100% pursue it. But the name of the game is not forgiveness. The name of the game is paying the least amount over time. And for some people, that's going to mean paying their loans off aggressively. If your income is high compared to your student loan balance and you're just sort of starting your PSLF journey, you just started working for a PSLF eligible employer, PSLF is probably not going to be the strategy that has you paying the least amount over time. But you need to figure out which strategy you're pursuing. I see people asking about, you know, should I be paying extra interest or should I be making extra payments? Not if you're pursuing PSLF. If you're pursuing PSLF and you feel like you're going to get forgiveness, you should not be paying a penny more than you're required to pay, because you're just stealing money from yourself. And then there's some people that say, well, you know, I ran the numbers and I end up paying the loan off before getting forgiveness. That's awesome, because again, you didn't lose anything. The goal isn't forgiveness. That's not the winner here. The winner is the person that pays the least amount out of their pocket. And again, for some people, that means just paying the loans off aggressively to reduce interest costs. And for other people, it means pursuing a program like PSLF. So don't get dazzled by the word forgiveness. Make sure you run your numbers. The Department of Education's website, so that studentaid.gov that you see in front of you, there's an awesome tool called the Loan Simulator tool. If you go to that tool and plug in your numbers, you only have to plug it in once and check the PSLF box. It will tell you what strategy is going to cost you the least amount over time and whether PSLF is going to make sense to you or not. So I urge everyone within the sound of my voice to check out that tool. So with that said, I also want to thank all the people, all of you that are here to sort of take control of your loans rather than letting them control you. And of course, my fine feathered friends that helped me with this presentation and the Q&A. I'm going to stop the recording, but again, I'm going to hang out and type furiously to try to see what questions that haven't been answered yet get answered. Before you post questions again, I encourage you to look at the already answered Q&A and see if it's already been covered.